gather as much as possible. Jeff, I'm getting ready to start. Starting this, you all know what it's about. It's about the potential deductibility of a portion of your entrance fee that you paid in. In other words, when you paid something in, you generally had let's call it $1 million, and 30% of it stays with Viamonte, and the 70% returns to you upon the time when you leave the property. So that's what it's about generally. I'm just going to questions during the course. Go ahead. You don't have a large. Oh, okay. Okay. I didn't realize. Yeah. No. I'm happy to. Here we go. Okay. Tell me how the volume is once I get this hooked up. I was trying not to be next to this and just talk out to everybody directly. Just opening comments to start with. As I mentioned, questions are okay. I made a note here just to say I was not a preparer of tax returns, and so my expertise is kind of tangential with all my people in my firm and doing my own tax returns. So, but I understand this issue deeply after doing it. This is again the 5th year I will have been doing this, essentially the same thing. A lot of people kind of the history of this. When I first started doing this, I was one of the ones that said, "Say what?" And we can take the part of our. Yeah, am I getting okay? Reasonable. Okay. Am I getting to be able to deduct a portion of my entrance fee? Yes. I mean, that was the thing, and nobody really understood that. It was just no tax practitioners did it and all. And it finally came to my attention when one of our former clients moved back to Massachusetts, and when she went into her CCRC back there, she had this presented to her, and she forwarded the information out to me saying, "Are you aware of this? This should be something you should be aware of." And we started checking around, and a few other firms were familiar with this. And then, so people are kind of like, well, okay, I'll go ahead and do this. I'll submit it with my tax return with this. But if it isn't something within the law, and that's a good point, there is nothing in the Internal Revenue Code or the related information. It just doesn't exist. It's just something that's there. And so it's gone on now for a number of years, and there has never been a challenge. We've never heard anybody in any CPA firm or tax preparers has been challenged on this, but it's just kind of a phantom deal that's there. Okay, let's see. I had a comment here to talk a little bit about the standard deduction, the option for obviously of making all these computations that are necessary for this is just taking the standard deduction. And a lot of people think, well, that's a fallback. That's not a good thing because, but if you've failed to meet the what I'm doing, I'm sorry, I'm just, if you don't achieve the deduction by this process we're going through with the whatever, you've got the standard deduction there. And for a married couple this year, it's going to be $33,000 for a married couple, $16,500 for singles. And I say, it is the best thing that happens to you is the fact that you fail the ability to get your deduction under here unless it's for some great reason, because of the huge amount of medical expenses that you have, that you're able to take this deduction as outlined in the thing here. I understand they didn't. I did found out just this morning that they didn't distribute the final page of this package that was supposed to come out. So anybody that's there and if you're subject to it this year, take one. If you're not, if you're just here for entertainment, please, because we're down to very few. Do you want me to make a bunch of copies right now? If you want to, but I think it's covered the rest of it here. What could be about another 10? Okay. Yeah. Okay. Then we can ask when I run.
Yeah, I've got a question.
Yeah.
In general, what you're talking about.
Yeah.
Are you talking about our initial payment to get into Vidamonte, or
Yes.
are you talking about the monthly payment that we make?
That will come later, but this is the one. This is about the one.
This is down payment.
Yeah.
Or
This is
the
down payment.
payment to get
And then we're going to talk about the one that comes with the letters from VS. I call it VSL from the main group.
I have a question about the deductible, the non-refundable percentage.
Mm-hmm.
You say 30.
I believe it is. I don't know. It changed. It's changed over the years.
Do you know when it changed? Because I was told it was going to be 25%.
Oh, okay. Well, whatever it is, no, I do not know that. And, we can just check in with. I'm surprised that. Huh?
There are certain people have 25, some have
30,
30, some have
40.
80.
Yeah,
80%
right.
some of that.
Exactly.
It's all different.
Yeah, right. Exactly. We're aware of that, and I'm just. Let's see. So what I'm saying with respect to if you, quote, fail getting any deduction by the process we're going through here and all the math and everything that's involved in these sheets, don't feel that's a bad thing. When you look at the alternative, which is the $33,000 standard deduction for all your itemized deductions, it's a win on a couple of reasons. Number one, it eliminates any chances of you being audited. I mean, that was large contributions on an individual return were often a reason for the IRS to audit. And if you do the standard deduction, it blocks that off. It saves a tremendous amount of paper time and everything, taking all your little slips of paper and showing your tax preparer that these are actual deductions that should be there for whatever purposes they are. So I say it's good. It's really a good thing. Another thing I've noted down here, with respect to tax preparers, last year I was just inundated with people, or the last couple of years, but primarily last year, please tell me a tax preparer in the local area. And nobody can tell you that. I had a business card of one gal across the street there that some people were using, and then they came back and said, boy, was she expensive, so I don't know about that one. Let's see. In fact, my firm, I had a 50-person firm, and I had some people who really needed a tax preparer, and they're good friends, or very good friends of mine. Two of them, one last year, one this year, and I went to the managing partner and I said, I know you're not taking any new tax clients, and I had to beg him. Beg him to take those individuals. I mean, it's that tight, and it's all the way through the industry. The problem is that whenever you have a law change, it's a clear sign for people who are, let's say they're a 67-year-old tax preparer. I don't want to have to go through and learn that new tax law. I'm out. So the supply has gone down. The number of people who are going into accounting majors in college and coming out is dramatically down and all that stuff. So it's just a supply and demand thing. And what I tell people is, how did you feel about your preparer you had last year? And somebody says, well, geez, they're back in North Carolina. I say, no, that's not the question I'm asking. I'm asking, do you have a tax preparer you had last year? And if so, did they do a reasonable job? And if they say, yes, they did, I say, keep them. Keep them. Do not think somehow you're going to easily come up with finding something here. Those people just aren't available. So,
Bruce,
yes, sir.
what would be a reasonable fee for preparing a reasonable tax return?
Reasonable tax return. It depends. How many? I mean,
Ballpark, figures if we could.
I'd say the bottom side you're ever seeing is probably $1,000. I mean, and that's on the low, really low end. And I'm not talking about Jackson and Hewitt and stuff like that. I don't know about that. That's more on individual preparers. Excuse me, I'll get on this thing a little bit more. For returns, I mean, if they're getting up over 2,500, they're starting to get a little bit pricey. You know, mine with my own firm, and last year, 2,500, and I figured that was almost cut back a little bit because I was a good guy. So any other questions on that, on the preparers and availability of preparers? It's a tough one. A lot of people are just surprised, and it's just unbelievable. I probably had 50 inquiries about, get me a tax preparer last year. And therefore, that's whatever. So one thing I want to notice is really disappointing to me about the Viamonte, excuse me, I've got talking going on in the front row, so I'm sorry. Yeah. Let's see. Disappointing in the administration, particularly in VSL's end of it. But I mentioned from the Finance Committee, which I'm on, you have an obligation to tell people this one change, which is you cannot put in estimated tax payments or any paper transaction with the IRS in paper anymore after the 1st of January.
After the 1st of this year.
Yeah.
From now on, it's going to be all online.
Right. It's all online and so I said you have an obligation to get that word out to everybody in all of your locations there so they can begin, so they're just not caught off guard and really get, excuse me. Yes, Ron.
Is that state also? You talked about federal.
Yeah, I'm assuming it's the state run, but I do not know that. I haven't seen it come out, whereas the feds published it, and I haven't seen anything come back from California, but I'm just assuming I'm doing it on both of them. I'm doing it on federal and state, so I have not been impacted by that. But I tell people, if you're setting up, your submission electronically through your bank system, do it for Fed and Cal at the same time. And California's, frankly, once you get through the Fed, the California just seems easier to set up than the federal does. There's less information asked for. So I'm just going through. Let's see. Well, I want to give some credit to Janet for catching an error in my in my original page there, the one called example, there's one where it comes down that says $165,000, excuse me, $165, and that should have been $16.50, but she picked that up, and then I had a call from somebody else, I can't remember, it says the same thing. So, I'll talk about a couple things here now too also, and it's less about the mechanics of what the calculations are on the sheet, but we'll get into that somewhat too. In February or March, the VSL, my least responsive institution, has the responsibility to send out a letter to people on, I'm sorry, just kind of dizzy today. Last year, it said for each husband and wife, $6,000 of medical expense deductions. $6,000. It's supposed to come to you in a letter, and then the problem with that is that they're very late on it, and so it ties into a couple things. I tell people, if you're, the thing I do at first is I go through with a first cut and taking my information into my firm and have them take a first cut, and then I say, okay, these are the things that are still open, and it's easy for them. They just make a list at that time. You know, we're missing something with respect to medical expense, and then it's easier and fast for them to finish up the return at that point. So think about that. But what I noted here was I last year used estimated numbers. In other words, 6,000. I didn't have a letter yet from them. I don't know what it was. And there's another thing that affects these calculations where they give us what's the percentage of medical use within all the expenditures are done there, and so in the prior years it's been about 5.5%, and that's used as a critical calculator in the computation sheet there. They don't get that to you either. So I really encourage, I'm against the law on this one, against the IRS wouldn't love me, but put in a reasonable estimate, and you can always ask people who have been here, what do you know was used for that before? And it seems to me on that big one, it's been about $6,000 every year. Just it's kind of a. Do you recall, Mark, receiving that letter?
Yeah, I do.
Yeah.
I recall receiving it.
Also, they do it one letter to wife and one to spouse, and so you get two different letters. So don't get confused. It's both of them, and it's the combination of both of them. But I've done that. I've done that for years, where you just stick in something, and if I have any doubt, significant doubt, maybe I take it on the low end of what I think it probably is, so that there's no question if I am audited. But it's better to do that than just to have your whole return sitting there waiting in a CPA firm or a preparer. They're waiting for one little bit of information, and then you get into this hairball of uncompleted returns right at the end, and you go, oh my God. So I do let's see here, the next thing. Oh, this is one I says, I'm going to almost repeat this. I will read this because it's a sub-factor and may affect some of it. I say, we note two situations which dramatically affect whether you'll be able to generate a deduction for the sum of all your medical expenses for 2025. The first is whether you sold your home in the same year you moved into Viamonte and paid your entry fee. It came to my mind is it says sold your thing. Sometimes people think I sold my house. This is probably a very improbable situation, but they sold their thing, and it actually, there was a no closing, and in their mind, they had it's something where somebody agreed to buy the house, but it hadn't closed, escrow and everything like that, so it's kind of, yeah, it's infrequent, but it does happen. Let's see, the reason that we find often the resident has a large taxable gain from the sale of their house if they owned their home for many years. And I was just talking to somebody here, and they said, just had it for about 4 years. Well, that generally the basis, what's called the basis in the property, or the property hasn't increased in value that much, so there's not that much gain potentially in there. But a lot of people have, 30 and 40 years they've had their house, and during a period of very rising residential residential properties, it pushes out a big, a very, very large thing, and that's the thing, just closes out this calculation right there. You know, because some of you who read the thing is, your limitation on the itemized deductions is 75% of your, they call it adjusted gross income, and I say in the parenthetically, essentially the same as taxable income. And if you have a hairball, like a huge gain from, as a lot of us did when they sold their homes, and without having a basis step up, if they had a basis step up, if anybody has a question on what a basis step up or where it comes from, but it's basically it's raising what is called the basis of your property up to the date of that you the person passed away, and is reflected in your estate tax return. Let's see. I say if the large gain is added to their other normal taxable income, dividends, interest income, required minimum distributions, which is a big one, big one. A lot of people are $100,000 always in required minimum distribution, which is taxable. Taxable social security benefits, and then pensions and things like that. When you add them all together, it pushes it up over the 5%, 7.5% taxable income threshold. So let's say in this big thing here, I don't know what that calculates. Maybe I have it here. What that comes up to, but I have a little thing that shows possible. It's down here at the bottom of the thing. Just the thing it calculates a simulated thing. It says calculate the 7.5 threshold. And I show these various interest and dividends, required minimum distribution, taxable portion of Social Security, and then the gain on the sale, $750,000, and it gets up there quickly. So if you take that number, 7.5% of that's $56,000, and so that's a pretty buy. And I always say, think of it as a big wall right in front of you. You just start, and every time you add any bit of income, you're adding this thing that raises it by 5.5%. And so if you have a $1 million taxable gain on your sale of your home, forget about it. It's gonna take that threshold so high that you're not going to have enough itemized deductions to get this. And that's one of the things. If making these calculations early, find out early, am I going to make it or not? Because you save yourself a lot of time and brain damage, and sometimes going in and saying to my tax preparer, I don't understand this thing here, understand it, and all of a sudden you find out he charged 3 hours for understanding what it was. Get it, so you say, you walk in there and you'll be very impressed. I looked in to see whether I, possibly qualified here or not, and I did not, so I'm just telling you that you don't, we were not going to be getting a large medical expense, end of issue, so that it really avoids a lot of time and paperwork on behalf of whoever your tax preparer is. I do recommend, though, that anybody that got this thing, when they provide a copy of this to their preparer, I mean, this is going to educate them on this subject, and it won't take them long to read, and then they'll be very impressed when you come in and say, hey, I went ahead, I made these calculations, and I determined that I am not going to qualify, just letting you know, so, but saves a lot of brain damage.
Excuse me, Bruce?
Yes.
Where did we get that document?
This one was put in the box of the, about 14 people who were there. I wonder if I can, get, Sarah to, I have gone in before and tried to say, hey, can I just shoot a couple pages on the thing and that thing? And they say, no, it's not for that. It's not for that use. And also I'm reluctant to say, just grab a copy of this. But that's how it'll be. I think I had two left over or something somewhere, but those are ones I'm almost keeping for next year to hand off to whoever takes over this next year. But that's I mean, if you said to me, hey, can I give you mine to, or anybody here, if they say, hey, I'd like to go down and have a copy made separately. Yeah. Because I'm also saying, yeah, leave a copy of this with, with your preparer so they know what we're talking about. Let's see, other things I wanted to cover here. Okay, let's see, first thing. Yeah, now again, those that first year, you won't know that you are supposed to be getting a letter from what I call VSL, and it comes late, and that's one of two letters that will come. There's another one comes, and that, yes.
Do they send that out to everyone or just to certain people?
No, it comes out to everyone here, yeah.
Every
And as far as I can figure out, some people say, well, do I need, if I came in November, do I have to prorate it? I do not know the answer. Probably logically, the IRS would say yes, but if I have this letter and I'm going to go ahead and I'm going to take the full 6,000, but I don't know the answer to that. Do you know what I mean by prorating? Yeah. Mm-hmm. Excuse me, somebody had, yes.
Yeah, that was one of my questions too.
Yeah.
I accepted an apartment and put my 10% deposit
Yes.
down in December of 2024.
Mm-hmm.
So are you only talking about money that you actually paid in 2025?
If you put the money down and then you moved in 2025,
Yes.
I mean, we're talking, that's part of the big entrance fee or just some deposit?
Well, it's a 10% deposit when you,
Yeah.
sign up
Yeah,
and accept the apartment.
Yeah, no, it's when you put down the big payment, the final.
The big payment.
Yeah, the big payment, yeah. So you're not,
That's a 10%.
yeah, you're not,
If it was in the prior.
yeah, that doesn't say, oh, gosh, you should have been doing this back in 2024. No, it's when you put down the big money.
Okay, so you
Yes.
subtract the 10%.
Yes, Ann?
That 10% then is part of the entrance fee.
I think it is, yeah. I think it is, yeah. Yeah, it is. Yeah, they don't refund it and then you repay it back again. No, it's all part of that. I'm sure they just roll that over into the entrance fee, but it's the same, yeah, the same. Let's see. Yes.
I've done some reading on the taxes for this
Yes.
It seems to me that there is, you said that $33,000, if you reach that amount,
Yeah.
that's your standard deduction.
Yeah, right.
I think you have to add on to that now, because of the new bill that just was passed, is $6,000 for each senior, meaning that you would add $12,000 onto this 33, making it $45,000.
Good, good.
So if you have,
Yeah.
if all of your deductions don't
Yeah.
add up to $45,000,
5,000.
you would take that standard
Yeah,
deduction.
right, right.
If you over that 45,000, then you would
Yeah,
itemize.
right, yeah, good point. I missed that. I missed that addition to that. That's very significant. And then that really cuts down the number of people that will ever benefit from this process. Let's see. Okay. Okay, I just made a couple notes here. One is it's suggested that you provide a copy of this information to your tax preparer, if any. All 4 pages of it, so they can read it and be done. That's basically everything I'm going to say. I'd be glad to answer all questions, any questions, and I'm always available. Just tap me on the shoulder if I'm sitting out there having a cup of coffee or something, because people do. So all you have to do is just, if you have CPA by your name, as my dad used to say, oh, that's for cleaning, pressing, and alterations. So any questions now? Jeff, you're a sharp guy. I've expected some good, deep questions.
I'm going to trust my tax preparer.
Good,
I
good,
got a good one.
yeah,
But thank you, I've enjoyed this, thank you.
yeah. All righty. Yeah, some of the most important, the most important thing is just feel very pleased if you come out with the answer on this thing is, no, I don't qualify, I'm going standard deduction. And particularly after what Ron said there, I'd seen references to something about 6,000. I didn't know that that was a connection and an ad there to people. That's people over 78.
Over 65.
Over 65, yeah.
And it's, the reason for that, at least given by the Congress, was to help seniors not have so much of their Social Security taxed.
Yeah.
So they raised the standard deduction
Yeah.
which gives you a break on your taxes.
Yeah. Hey, just one real small one, an element of medical expenses. When you'll get the Social Security sends you for each of husband and wife a thing like this, and it's just a report of, how much Social Security income you receive. It's like a 1099, But in there you can pick up the fact of how much has been withheld for Social Security taxes, and comes out to be a pretty big number. And I always try to mention that to people when I'm telling them these are the deductions you should be looking forward to. Any other questions? Yeah, Dave.
Moral of the story, you should do your own tax return.
Say again?
The morals of the story, you should do your own tax return.
Shouldn't do?
Should not.
It depends on how if it's I don't know. I mean, it's a lot of it is the volume. I mean, like I had 18 different real estate investments, and K1s and everything I had to do. So I had just tons of volume coming through there, and so I had it's not something I wanted to be doing on my own, and there's a lot of complexities that just it can be kind of worth the time to have somebody.
I would say if you sold your own home in the same year that you're asking for these, or looking at the deductions, have an account to do it, because you try and get the least amount, and so many people have been in their homes for 30 or 40 years.
I should have had this down in the thing. I can give a kind of a discussion on that one. In other words, Yeah. Let me speak to that. So in other words, your taxability on the sale of your home is the difference between what's called your basis, and everybody always thinks, well, that's what I paid for my house, and what your net what you sold it for after you deduct all the commissions and everything. So the things that you really have to be looking for, it really is, and I knew that to be, and I told my children, anytime you buy a new something or you renovate something in the house, start making a running list. And so they're all running these lists. So this is in addition to what you you paid $62,000 for your house, and now you have put in new wallpaper. That's okay. Yeah, that's okay. But things like painting. Oh, I painted the inside of the house. No, that's called repairs and maintenance, and that's not same thing. The exterior, But even if you put in a new garden or something like that, that's all part of the basis. And there's all these things, and capturing those. And it's a good thing to tell any children or people you have is really keep good track of that. But if you don't have that, just start walking around the house and going, oh, that wasn't here when we got here. We did that and everything like that, and pick them up. And sure, you're going to pick up a few $80 here and there and that, but it adds up. I mean, I think we probably, on our basis calculation for the gain in our house, I probably had.
Don't have your spouse die, don't worry about it.
Oh, ouch. That's true.
So Bruce, that actually raises the question
Yeah.
for those of us who've moved into Viamonte
Yes.
and invested, whatever,
Yeah.
15 grand to put in a bunch of shelves and that
Yes,
sort of
yes.
stuff. Should we, in fact, be tracking those?
Oh, absolutely. Absolutely. Those are the big ones. Yeah. Yeah, those are kind of easy to remember. But even if you don't have the invoices and everything for that, go ahead. Just take your best number you can remember. Oh yeah, and something like that you remember. Somebody just told me their California closet steel was $24,000. And you remember those numbers. It's the numbers for smaller things you did, or you had the floors, resealed or something like that, or took out the floors and put in new something. So it's there, but that's a important one.
I don't understand that. You're talking about the
Basic.
improvements that you've made to your apartment here in Viamonte?
No. The house you sold before you.
No, I'm talking about here at Viamonte.
Oh, here there's no. Oh.
You're set.
Yeah, there's no basis calculation. I mean, you don't have a taxable transaction when you move out of here.
Yeah, but what about at the time that you pass on?
Mm-hmm.
And your apartment initial investment, the entrance fee, or portion of it is refunded.
Yeah.
Presumably, that will be included in your final tax return.
No, that's just returning your own money.
Really?
Yeah. Mm-hmm. So that.
So anything that's done internally, forget about it. You're not going to get a tax benefit from that.
Yeah, but just do as they say there. Make sure you have all your errors and everything clearly defined in there. In other words, if they have to make a payout to somebody, when they're leaving, just even your 70% coming back or something like that, they got to have very specific work done to run. I think you've emphasized that before.
Mark, on what you're talking about is that they're going to come in and inspect your apartment when you leave. And if they find damage, maybe a couple of $1,000s or whatever, I think it would be very beneficial if you said, but what about the cabinets that I put in, and the closet that I
Yeah.
redid, and the electrical work,
Yeah. that's a good point. It's a good point. Another one I went at them in the finance committee, I said, I think you guys are probably leaving a lot on the table. When people come in and inherit, I mean, like in our situation, we probably have $25,000 worth of improvements in there and everything like that. I'm not asking for it back, but I said, put some.
Don't charge me for
Yeah.
a whole
Well, no, it's not that so much. It's just make sure that the people coming in, like Jeff, God, he couldn't stop bouncing off the walls about, my God, you can't believe the.
Not bad.
Yeah.
You really did a good job.
Yeah, but just see the improvements to his unit that he moved into. He was just.
So they charged you for it?
No, they didn't. He found gold. Yeah, they moved her out of there and left everything. And probably.
That's the mistake Viamonte makes.
Uh-huh.
And I don't know if after you move out, I mean, this is California real estate.
Yeah.
And I know up at the Forum, which is up in Palo Alto, when you move out,
Yes.
you get everything back and you split half of the profits. Because these
Uh-huh.
places,
Yeah.
if you paid $1 million
Yeah.
for yours 4 years ago,
Yeah.
they're gonna sell it for 1.3 million.
Yeah.
The
Right.
next time it goes around.
That's right.
But you don't get any of that.
Yeah. No.
You get 75% of what you paid
Yeah.
originally.
That's the game.
That's what you signed up for.
That's what you signed, that's exactly what you signed up for.
Yeah.
That's the promise, which is what you signed up for, basically.
Well, however you paid for it.
Yes.
When you paid
I just think, as I say, when I'm talking about this, when people leave their units and they leave valuable property, Viamonte's always looking for something for this fund they can have for people to get in trouble financially and can't quite meet their things. Just don't. This is a natural source of it, is to say, okay, this unit normally would have been, $1 million, but you're getting in there fix-ups that have been made to that, and so we can't compare what we're going to charge you now for the absence of the improvements that were made. I mean, people have, put all wood flooring into their apartments frequently, and and those things, and so as I pointed out to them, I'm trying to, Melody, who never forwards anything you want, she said, that's a great idea. We need to cover that. I'll get that over to the execs over in VSL. Never get a word back about it. But that's just one thing I was presenting to them, because I think there's a lot of, as I say, it's Jeff. If you all of a sudden somebody said, well, this was the normal rate there would be, but there are some improvements in there, and we're not charging you full value for those additional, but we are recognizing additional amounts. So you've got $2,500 additional on top of the $1 million that you would be paying for this thing, and then that $2,500 goes off to VSL.
Of course, there's the other side to this. As I recall, when we signed up saying that we would return the apartment to its original state, which means out come the improvements to the closets, out come the wood flooring.
Yeah. It's a one-way street.
Yeah, that's right.
So it's a one-way street if they like what's there.
Yes.
And that's fine. But if something's significant, what was it? There were some overhead light fixtures, and we took those down and changed those.
Right.
And they said, we said, well, we're keeping them here. They said, no, don't worry. By the time you go out of here, we're not going to want those to be put back up to where they were. So that's a kind of a narrow example, but yeah. Yeah, yes, Ron.
What happens if, for example,
Yeah.
the unit next across the street goes in,
Yeah.
and the value of these,
We're not talking about Viamonte 2, are you?
Yeah.
You're talking about Viamonte 2,
across the street,
just straight there, okay. Yeah, townhomes,
if
yeah,
they go
okay.
in, and let's say the value of these goes down,
Yeah,
when you talk about your 25%, that doesn't, you still get 25% of what you put in,
that's right,
not 25% of,
that's right,
let's say they can't sell it
That's
for
right.
that much.
that's right,
Okay.
yeah, yeah. That's true, yeah. So anyhow, to refill it when we go out and everything like that, I mean, that's a loss there to them. And coming out of the net equity of the Viamonte or VSL. Exciting stuff, guys. Gotta love it.
Gee, I was banking on getting some big bonus for a final trip.
Yeah. Yeah, let's see, now, I wanted to distribute, that's, oh, you did?
Yeah.
And those are a couple left over?
Yeah.
There you go, good. Yeah, so, and that was really, I mean, again, I gave very specific typed out instructions and what they were to do, and just only this morning, all of a sudden, I was looking through the copies of these, and all of a sudden, I'm like, where's the fourth page? Because I'm always referring to the 4-page document. Hey, Dick. It's. You gonna roll through?
I think we may have gotten some signals corrected. Is this the veterans meeting?
Nope. This is our tax seminar.
Oh, I'm sorry.
Oh, Dick, come on. You're always welcome. I can't remember, we were on some. Oh, yeah, but again, the administration, I mean, very clear things, and I had the list of everybody's box and then put it in the box, and 4 pages in there, and the purpose was, and tried to, if you read through this thing, it was kind of like, do a computation earlier. I was encouraging people to make a computation before they came in here for today, and find out that there was no blank put in there. So in behind the deal, I had the example, and then here's the blank. This is the blank thing to do. So apologize for that, but it's